Here's an explanation to essential question number 1. This is one of the ones that we did on July 18th in the summer of 2011. This is the one that's about a small convenience store in outer East Portland. So what we have here is question number 1. You go outside and notice more graffiti. You have to pay someone to paint it over. So you're looking at an operating expense going up. That means net income goes down, and that always feeds back over into the cash flow statement. You see a decrease in cash from operations. Question number 2, it's gas delivery day. You need to get another tank full and an invoice, and you throw the invoice on the stack to pay at the end of the month. So what you're looking at here is you're going to see an increase in inventory, which is an asset. That's question number 2. And you're going to see an increase in liabilities that's over there, and that's what the invoice is. And so you see the increase in assets is the same as the increase in liabilities. So the balance sheet actually balances. And the cash flow statement part's a little complicated, so what you should think of it as is that if you separate it into 2 parts, if you had just had the gas delivered and paid for it in cash, you'd see a decrease in cash from investments. And if you just receive an invoice, it's like this, basically alone, you'd see an increase in cash from finance. So you have to put those 2 components in there. And so this is one of those tricky ones that actually shows up in 4 places. 3, state raises a gasoline excise tax, and this is just going to be one of those tax expenses on the income statement that goes up, and so that means net income goes down, and that means you're going to see a decrease in cash from operations. Let's see what else we have. It's not a good month. You take out a loan so you don't have a cash flow crisis. So what we're looking at here is taking out a loan. That's an increase in liabilities. It gives you more cash. That's what you have, an increase in assets right there. So those 2 balance each other out. That feeds back into the cash flow statement. You should see an increase in cash from finance over there, and that's the last part of it. So this one actually shows up in 3 spots. You have to retrofit some new emission controls on pumps to get them up to national standards. This one is basically taking some cash, decreasing it, so that you can go ahead and have an increase in your fixed assets. So your balance sheet balances out. And what you're looking at there is also a decrease in cash because you're adding it to an investment. So that's what you'd see in the cash flow statement, decrease in cash from investments. Nothing showing up on the income statements over here. The guy across the road raises prices, time to do the same, should not hurt sales. Increase in revenue, that's on the income statement, increases net income, and that increase in net income increases cash from operations. And let's see, question number 7, the propane delivery was made today. They wanted cash on delivery, and this is a simple increase in inventory, that's the propane, decrease in cash, that was you paying for it, and you're also going ahead and having a decrease in cash in investments. So basically it's a little chunk of working capital there. And the final one is you take some of the profit you made last month to live on. You do this in lieu of salary, so we know there's no salary involved there. Basically what you're doing is taking some cash, so there's a decrease in assets. And what's balancing off is that there's a decrease in owner equity. And so you see how you're always making sure that balance sheet is balanced. Anything that's got to do with changes in owner equity shows up in the finance section of the cash flow statement. So you'll also see a decrease in cash from finance over there. And so this should be the explanation for essential question number 1. This is the one that was given on July 18th in the summer of 2011, and it's the one on a small convenience store. So thank you very much.